going to go over some of the things that we've been doing in the last year, and then we're going to take a look at what we have on our agenda for the next few years. Now remember that what we primarily do is research and development for the joint venture. So last year we had a timeline of sorts, and these were the things that we were going to be working on, developing, and approximate dates of delivery. And we've been able to reasonably keep our delivery schedule. And as you can see, we're over here right now. And what we've done so far is we've completed the development of the main underlying systems. And we have some challenges ahead of us, including developing more rule clusters for stops, and we'll show you all those kind of things. Now, our objectives were to put the signals into software for testing, trading, and improving. We wanted to develop new automated trading models by combining signals and finding subsets that are really useful. We developed computerized systems for the joint venture to use for trading systems. And part of our objective is to develop a real dollar track record, which is yet to come by the JV. And the other part, of course, is to develop a business that generates revenue from trading these systems. Now, some specific goals that we had was find a usable trading platform and database, put various trading patterns into the software, test and optimize various patterns for Forex, computerize the better patterns to get results, show tests that meet that criteria, and find most productive subsets of these signals, improve signals with additional techniques. And so what happened was we went on and we built various systems. We built sandbar systems, ZZF system, ZF system, Fake 4 system, 5X, GPR0, GPR2, and EP systems. And we tried combining and doing different things with it, and I'll give you some idea. What we do is we do development, and so this is to give you some idea of the development process itself. How do we decide what signals to use? What is it based on, and how do we improve a signal? We'll take a look at that. Well, think of this kind of like steak. Okay, this is a T-bone steak, and as we look at the T-bone steak, we can see that this is the main portion of meat. Over here is the bone, and it's kind of in the shape of the letter T. And over here is the fillet, the really good stuff. Okay, and here's a whole bunch of gristle. Okay, and so what happens is in the development of trading systems, you wind up developing ways of how to understand how good the trading system is when you look at it, and we look at certain criteria. And so what happens is when we look at a piece of meat, we have certain criteria in our head, like how big is the bone, and how much fillet there is, and how much gristle there is, and how much regular steak there is over here, and what that looks like. So there's a number of criteria, and we're going to take a look at some of those and kind of make sense of them and think of them kind of like steak, like a good old T-bone steak. Okay, so what happens is let's say we're out to find the fillet. We're out to find trading systems that give us some good fillet. Okay, well here we did a trading system, and this one apparently looks pretty decent. I mean, it gives us numbers like annual return 49% and 300 some odd trades over a 2-year period. And that seems like a reasonably good test. And so we look at other factors to figure out what's going on with the fillet. For example, we'll look over here at this number here, and this is called the average profit/loss. And so these three, if you take 320, all the trades, multiply them by this number here, you'll get the ending, the net profit actually of the system. And so the bigger this number here is, the average profit loss, the bigger the fillet. Okay, the more fillet there is, and you want to make sure there's enough steaks available. And you look at this number here, and this one says 320. Now, if this is a 2-year period of time, that means 160 a year. And so if you have 160 steaks available to you a year, that's a lot of steaks. And so that's probably more than you need. So that's a good number. Okay, and over here we can see one column that says long trades and one says short trades. So the short trades start by selling and then buying later, and the long trades start by buying and then selling later. That's all it is. Now what's not seen on here is how much bone there is. And how much bone there is in the steak, so to speak, is something called max system drawdown. Now in this one here, while this looks really nice, these numbers here do, the max system drawdown was about 25%. Now, here's how to think about this. If your annual return is 49 and your max system drawdown is about 25, then if this is your entire stake, then and max system drawdown is the amount of bone, well, gee, then that would be about 50% bone. Would you really want a steak that's 50% bone? I don't know about you, but I don't want one like that. So what I'm going to do is I'm going to take a look and see if I can, since this is the average steak, and there's 320 altogether, what I want to do is I want to see if I can find some other criteria that helps me to determine when I'm going to get a better steak, because this is obviously a decent batch, and I just have to be able to figure out how the computer can determine when we get the better ones. Okay, so let's take a look. Okay, first of all, what is a computer looking for? Well, computer's looking for something called EP patterns, and here's an EP pattern sell, and here's a buy, and here's a sell, and here's a buy, and here's a sell, and here's quickly a buy that winds up being a little loss here. Okay, so it looks for these patterns. And so here's another EP pattern sell, and here's a buy, here's a sell, and here's a buy, here's a sell, and somewhere in here, I don't quite see where, but there is yeah, here's a buy. Let's see, yeah, somewhere in here, yeah, it's hard to see, but there winds up being a buy in here. So an exit for this one here. Give you a little clue. When you see a solid arrow like this here, okay, that means it winds up buying and then selling later. And when you see a kind of hollow arrow like here, you have a sell first and then a buy later. Right? So, and sometimes these are kind of tricky to see. See over here, you see the green arrow. Here's a buy, and here's a sell. So the name of the game is to find the fillet signals. Now, what would be a fillet signal? Well, I think being short here and buying it back over here, that would be one heck of a fillet. Well, these little things, maybe not so much. They're good morsels, some of them, but not so much. This would be the real fillets. So maybe, maybe we can do something that would help us to determine how to know when there's going to be a fillet. Okay, so here we can see see that we have all these fun little patterns in here, and we can draw a median line, and we can see that when we draw these lines here, these downsloping lines, prices kind of bump up against them on the third time here, if this is a sell signal, and then also bump up against the median line. That's kind of neat. And we take a look at this one here, where we had a sell, and sure enough, we have the same kind of thing. And here's another one. Wow. So we've got a bunch of these guys, right? where it just kind of goes up and boom, and there's your fillet. So maybe if we can tell the computer somehow how to know when this kind of pattern is present, and then use a median line and a trend line to test for this pattern, then we have a fillet finder. Now this is easier said than done. So, and we can see that when we get signals, and they're all over the place here, some are better than others. Okay, this one here's a nice fillet, and here's a sell, here's a buyback, here's a sell, here's a buy. Whoops, that winds up being a little loss. Okay, so and here's a buy, here's a sell. Wound up being a loss. Okay, so you really want the fillets, and if there's some way to figure out how to pick those fillets, that would be really, really neat. And because some of these signals are good and some of these signals are false positive. So here, for example, here you have a nice sell. If you wound up selling here, and some of these are false positives. So the false positives turn into losing trades, and that takes away from the fillet, and that's no fun. Want to have minimal amount of those. And so here, for example, we have a pattern where the arrow comes in and says, hey, sell, and boom, and we get a nice little down move. And notice once again, we have a nice little 3P here. So somehow we need to incorporate this trend line in the signal and figure out how to know where to draw these lines from when you get this kind of a pattern. Okay, so what we do is we'll do a test, and here we'll get the kind of like the stake itself. Notice the average profit loss is 15. Okay, and then we go down here, and the average profit and loss is 888. Well, that's on the fillet meter, 888 is much better than 517. Actually, it's about 50% more quality. So, and also notice that you have a total of 329 here, and here you have 139. And 139 is still a reasonable number. Remember, over a 2-year period, that's about 70 a year almost, and you can easily do okay on 70 stakes a year, right? That's still a fairly decent number. So, and also notice that you have a smaller number of winning trades with the higher number of trades here. So you have these wind up being much better quality. So what happens is we do this computer analysis, and then what we do is we work on finding what the subset of these are that makes it easy to find these. And so we look over here and we see that these have the number 3 in this third column here, and we can see some of the other things that are unique to this high amount of fillet meat, right? And that's one example. Now another example would be that we specifically did. We looked at a system and we said, okay, now altogether there were 152 trades and 80 were winners. And what we were doing was just analyzing the entry signal itself. And we said, okay, well, we did an average of 427. Whoop. And so think of it, that's like the meal. That's the salad, the vegetables, the meat, all together. Okay, 427. Now, if we take a subset of that, if we look at only the meat, okay, we get 91 trades altogether, 54 of which were winner, and the average trade was 1309. Now that's steak. That's pretty good. That's a much higher number than on the meat index, quality meat index, than the total up here, 427. What we found was that inside Formula A, we could break it down into 2 different signals. Okay, and we found that this here was the bone, and this was 61 trades and 26 of which were winners, but in the long run, it really lost money. And so figure, it loses a lot. Well, that's bone. We really don't want to eat a bunch of bone. So what we can do is we can take this system here, Formula A, and take away Formula 2 trades, and we get wound up with Formula 1. And get 1309. That's pretty good stake. So we have that, and then we work it a little further, and we say, okay, if we have this Formula 1 thing here, can we break it down into two different trades, some of which are better than others? And the answer was yes. We had Formula D and Formula E. And Formula D gave us an average of 874 per trade, and Formula E gave us 1502. So basis, what's coming up here, we would say that this one here is definitely the fillet, and this one here is some reasonable steak. So we probably want to take both of these here, because if we take all these trades here, we effectively take this one here. It's the same as this taking the Formula 1 trades. So that's kind of neat, and we would know that these ones here are more likely to produce a higher number, and these are more likely to produce a winner, because notice that 22 were winners out of 28, and on this one here it was about half the trades were winners. So what we can do is we can think about how much we want to risk and change how much we want to risk when we go for one of these 874s versus the 1502s here. Okay, and before we put the trade on, we can know what this is. Not a problem. Okay. Good. So let's move on. And then so that was the entry, and that's one set of criteria that we look at. And then another set of criteria when we build a system is what's the exit, and what criteria do we look for that? Well, what we did was we tried different exits with some of these systems, and we found that on the same data set, we were able to get 32% annualized profit, or about $74,000 using one criteria, which will happen to be something in the course we call a major pivot, and using a different criteria, we got 31%. And so we were sitting there saying, well, what might happen if we put them both together and stuff like that? Well, the programmer said, okay, well, we'll put them both together and just take the first one. And lo and behold, we got 104. So this was a dramatic increase. And so what we're using, of course, is exit number 3. And exit number 3 winds up being more reliable than exit number 1 or number 2, remember, because exit number 3 takes the first one. It doesn't hold out for a longer time necessarily. Now we're going to talk about building systems. Let's take a look at things piece by piece when we build a system for trading. Let's say we start something that we first, the first signal we developed was something called the EP, and this here is the S&P or the Dow Jones. And if you remember, at the end of December, we put a post up on CNN saying, hey, look, for the month of January, the stock market is going down, and lo and behold, it did. And here it was, down she went, boom, 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 boom. Real nice. Okay, and so what we did was we did a test on a whole bunch of EP data using certain rules for exits and entries, and we found we got an annualized return of about 11% a year. And we found that in the last few years, well, the longs outdid the shorts by a lot. Actually, the shorts were losers. Net losers. And what we found was that the average profit per trade was about 630. Yeah, that sounds like a good stake, right? But what really kind of neat, the average long trade was 1902. Now, since we've been in a strong up market, this is not this is natural. And so what happened was we decided to do another test, and this is an EP test in the I think this was in Forex, and so what we see when we get these numbers here, besides looking at how big the stake was, this was 347, which is a workable number. So we can look at and we can say there were 317 trades. And so when those numbers are big enough, what we can do is we can do some analysis to find the good subsets, right? Like I kind of talked about before. And the other numbers that I look at are exposure. And exposure means what percentage of the time am I actually using the capital in the account, because the capital sits idle and doesn't do trading a lot with some system, yet the system still does rather well. And the other number we're looking at is percent winners. And we notice here that this one's 45%. So while the annual return looks reasonably good, the amount of stake is it's okay. The number of stakes is great. Percent winners, I don't know. That might mean there's just too much gristle in there. So we'll have to look a little further and maybe do some work with that. Okay, so as we look at that particular system, we say, well, let's take a look at some charts, and we can see that here was a sell, and here was a buy, and here was a short, and here was a buy. It's an example. And those were kind of small morsels of meat, but I like the bigger morsels. And here's a buy, and here's a sell, and here's a short, and here's a buy, and here's a buy, and here's a sell. So this one took some reasonably decent size pieces of meat here. Okay. Now what we did was we took that basic thing and we started combining it with other systems we developed. And so one of the things we developed that we tested out with it was something called the golden pivot rule. And all this really, the form of the golden pivot rule we're using here is we're simply saying, okay, if you have an EP in the pattern here, which you do, then just kind of go back in time and draw a trend line and see if there's a whole bunch of little pivots along there. And in this particular pattern there was. And so that's called a EP with GPR. So we tested that out, and it said, well, the test said annual return of about 26%, which I guess is okay, and the average P&L was 758. Now we know that that's a pretty decent piece of steak, and there were 80 of those a year. Hey, that's a good number. All right, we get 80 of these good steaks a year. 53% were winners. That's not bad. And now as we look at this, we can see that these were longs and these were shorts. Now, since we did these in the Forex, not in the S&P, and the Forex does not have a long bias or a short bias because of the nature of the Forex. So you always have things going up and down in Forex, even though you always have stocks going up and down. In Forex, you always have one currency against another, and the same system that would give you a long signal will give you a short signal if you reverse the currency pairs. So it has some unique characteristics, and one of the things we note here is that the annual return on the short trades is kind of low using this particular kind of signal. Well, we'll kind of make a mental note of that and maybe come back to that later. But so far, this kind of stake here is looking pretty good. I mean, long only is doing there's 40 a year and 14.55. That's some good steak. Well, then we looked at some other things that we test out, and we found that what else is useful is prices when you have this EP pattern, the prices stop at the far H, and that's kind of neat. So we did that, and we found that that was useful. And the other thing we found was that when we have an EP pattern like in here, we found that when it stops at the median line, that's kind of nifty too. So, because as you can see, we had a nice up move after that, right? So what we did was we did a test on these three general formulas together, okay? And what we found was it came up with a number of annual return about a little under 35%, and the number of trades per year was about 40, and 75% were winners. Well, that's a decent number. Okay. The thing is that most of them were long trades, and we see here that the average profit and loss was 20.57. That's a nice piece of steak, right? And the average but the long trades were over 3,000, and the short trades were under 1,000. Okay. And so what we did was we decided to do something called selective currency pairs. Now in the normal system, what we did was we simply took the 78 currency pairs that IB trades, and we applied it to all of them. In this particular section here, we said, well, you know, if the Swissy pound has nothing but losing trades in the last 2 or 3 years, we'll exclude those, or something like that. And we wound up with a list of which ones to trade. Okay, so we have this, what we'll call a select list of currency pairs. And we filtered them, and what we got was, well, we got a bunch of less trades, first of all, or ones with less trades, and we wound up having 18% winners. Now, the only problem with this is that we had, you know, per year, 22 per year, and even though the quality of the steak was pretty good here, look at this, 32.26, and the percentage of winners was great, and the annual return was decent. We only had 22, and we'd really like to see a bigger number than that. So what we did was we applied long and short filters. So instead of considering the individual currency itself, we just ignored those and said, well, if a certain one of those three categories was more favorable on the long side or on the short side, we would gear it towards the one that showed the better things, and any ones that didn't show a really decent performance, we'll just, you know, so for example, if you had the EP, the golden pivot rule short, we could say, that didn't do so well, we'll leave that alone. Okay, where the longs did better. Okay, and so we wound up with this here, and so your average profit and loss was about 20.57. Nice steak, and this number was good, and so you know, and you had 40 trades, and that's not a bad number. That's decent, and 75% were winners. Okay. And so to improve it, we tried many different things. We tried adding these different systems along the way, and it just didn't do enough. So what we did was we did some thinking about something we used a long time ago, and that's something called Meyer bands. And Meyer bands are I'll tell you more about them and how we get to there in a little while. But Meyer bands are kind of different. And so what happens is that notice that we have an EP down here by the lower Meyer band. And so after prices close down through here several times, there's an EP, and then it goes up to the other Meyer band, and so, okay. So these can be used in the calculation, and what we had was we did a test where we said, okay, well, what about just using Meyer bands and the EP pattern? So, prices closed a couple times Meyer band, beyond the Meyer band, stuff like that. Anyway, what we came up with was winners were 67% of the time. And it was a pretty decent number. There was 80 trades altogether, and that's 40 per year. That's a decent number. 1309 was the average profit and loss, and that's a pretty good stake. Anything over 1,000 is very interesting. All right, and so these numbers started looking much more attractive. And notice now here it says exposure 22%, 23%. Well, that means that this system's only in the market about 23% of the time. So what we did was we added Meyer bands to the 3 other ones that we had, and we came up with something that gave us an exposure 30% of the time. So it utilized the assets more effectively. And the average profit and loss went to 1825, and we had 112 trades over a 2-year period of time. About 6 stakes a year. That's a good round number, right? And the quality of the stakes, 1825, that's pretty darn good. So, and on here it says things like 74% winners and things. So, okay. Now, if we added the Meyer bands to the select list, we get a little bit of a different number, but we might as well see the difference is you have a few less trades with the select list, so you can really go either way on this. Use the general list. Now then we did a test where there was absolutely no leverage, no nothing. It's called a raw test, and in the raw test we just said, okay, if we take all those trades and we only take first thing that comes along, and we take 100% of money and put it in that, what do we wind up at the end of the time period? And it said, well, you do about 22% a year. Average profit and loss is about $2,000. And so, and the drawdown on this, which is how much bone there was, so to speak, was about 3%. Okay, whereas the drawdown on this one here was about 8%. Now, what does drawdown mean? That's kind of like how much bone there is in the stake. Well, let me tell you. There's what it literally means is if you get in at a certain time, how much, at the worst possible time, how much does the account go down before it goes up again? In this case, it was 3%, and the annual return was 22. And in the other case, it was 8%. Now, would I rather use this system here or the other one? And it's just a function of what we call money management. In this one here, we only had 23 trades. So over every year, we only had about 11 stakes. But it was in the market about 70% of the time. Okay, where this one here was a bit more diversified. This one had like 99, or if you go with this one here, 112. Over a 2-year period of time, and it was using the capital a lot less. Technically, theoretically, this one was less risk. Okay. Now, so what's next for the Forex development? Well, what we're looking at is develop and test more types of stops, develop and test more types of exits, and then we're looking at doing some real-time simulation of the orders, real-time trading with real dollars. We're looking to test more approaches with the EP in combination and develop additional Forex systems, quite possibly. And for phase B and C, because right now we're in phase A, utilize intraday and other time frames. Okay, what will be done in phase B or C? Well, one of the things we'll take a look at is this Meyer band thing. Okay, over here we got a Meyer band buy, and here we got a Meyer band buy. Okay, and so what happens is it winds up not in all cases, but in a reasonable percentage, it winds up having a nice up move after that. So is there a way of using intraday patterns? Well, let me show you. So what we do is, this was one of those Meyer buys, okay? And what we do is and this is a 1 hour chart, because you got to remember that this here is a daily chart. And so this is like a couple of months this time period here. Actually, yeah, it's a little over a month, okay? And so if we can take advantage of that, and when we know that we're in a very powerful move, if we put on signals like here, we enter with a median line, and here prices come down to a median line that's upsloping, and we can do that with very minimal risk, and we can probably utilize a lot more capital. So if we have a lot of confidence in what we're doing, what we wind up doing is putting on bigger trades. Okay. And what we really like to do is combine these intraday signals with power moves. And here's a power move in the cattle. Nice that we're talking about steaks. Actually took this one recently, and wound up having a buy down here. Market went up and wound up standing aside and letting it come back down. It came back down to here. Said, okay, guys, I'm buying again. And here we had the power move. Now let's define a power move objectively. And if we can define a power move objectively as 5 consecutive further closes, or a 10% move, a 5% move inside of 10 days. Let's define that as a power move. And just for the sake of having something objective, and so we can look for those. And we have those every once in a while. Here was a recent power move in the stock market. And so here it went up, and here was our EP and stuff. And we wound up having what is defined as the power move in this section here. Okay. Here's gold pattern, and sure enough, here was the power move. We finally had the 5 up, boom, over here at the end. And in this one here, which was very recently, we had one over here. Okay, so what we find is that by looking for the EP patterns, it can help us in many cases in finding the power moves. So in phase B, we want to develop those power move strategies and signals. Now, what about the stock market? Okay. When it comes to systems for the stock market, we had some difficulties. We built some things that suddenly we thought were breakthroughs, and what we found was there was a glitch in the data and in the software, and what happened was on the exit, the software would automatically take the high of the day rather than the close. And when you have 5 or 6 trades like that in software, that when you're looking at historical studies and you have 5 or 6 in a row that do that in a long only system, you really need to examine that closely, because chances are there's a bug in the code. So we set that aside, and what we discovered was that even with a top-notch stock trading system, we would need a hedging vehicle. Now, a hedging vehicle means that if the stock market goes down, for example, that this hedging vehicle will kick in and the hedging vehicle will make money. Okay, and so we are working on a stock system, and during the ETF, during phase B, we could have an ETF model, one that trades exchange traded funds, and the advantage of exchange traded funds is you're trading a category. So the category might be trucking companies, and so this way, if the president of one trucking company quits or something, which impacts the price of the stock 5 or 10 or 15%, it's reflected in a very small percentage if you do it in an exchange traded fund in most cases. So that works out rather well. And and right now, the closest thing to a stock system that we have is going to be the what we're going to use for the hedging thing, and that's the NAPI system. Let's take a look on that. Now, the NAPI system is focused on futures, trading futures contracts, and in futures contracts, the leverage is always pretty high. And so here's an example of the NAPI system, and in this particular one, we found that we had 91 trades and over a couple of year period, and the average P&L was 48.23. That sounds like pretty nice stake there. And I will tell you that these guys are normally leveraged 10 to 1, and that's what we're looking at in our estimation. And so it winds up having a bigger risk and loss factor. So for example, in this one here, the down draw, system down draw was about 22%, and which is about a 5 to 1 relationship between the annual return. And so if you think of it as, gee, with this one here, 20% of the stake itself is not edible, that's something you could probably live with. If it's 50%, like in some of these systems that we don't touch, then you want to avoid it. So, and what we use for that is what I call an index signal matrix, where we did the historical studies on what seems to work best in the S&P, the Dow, and all that kind of stuff. And then what we do is we use that, and it helps make forecasting possible. We use that and some other things. And so we can, when we put numbers below here, that means going up. When we put numbers above here, that means going down. And we can combine that and those EP tech we've been working on, and we can, for example, combine this buy signal that we had in the EP with the NAPI, and that's kind of neat. And then, so getting back to what's going on now is that we're over here somewhere. We're looking at rule clusters for stops and exits, and doing product development, and then eventually having the IV trading interface done. And we're looking at having this all done later on this year. Right? And so right now, more product development is next. We're looking at testing next day orders, testing IB orders, developing products, and building for the future. Okay. Major additional software we're looking at, this would be in phase B, for a model a high performance portfolio in stocks. We can model an EPF portfolio, and we can do this all during phase B, and this would be quickly. This part for the stock market is something that could probably be done in a relatively short period of time. One of the things that we have that helps us with the Meyer bands is a relationship with some really smart folks. And this was an email that I received regarding what we do, and having a relationship with some really smart folks, and these really smart folks have some rather important technology that deals with artificial intelligence that helps us to determine Meyer bands and a whole bunch of other things. And if you're wondering who those guys are, who this email was from, the answer is IBM Analytics. And so in phase B, we will be using IBM artificial intelligence technology. So in phase B and C, we're looking at this list of things here. And that's what we have planned for the future. So I thank you for your time.